Okay, stop scrolling for a second because something just snapped in the silver market. In one session, silver fell from near $120 to roughly $78, and then today it ripped more than 12% higher to around $90 an ounce. That's not a typo. That's a 40 plus dollar round trip in days. And here's why this matters right now. While everyone was arguing about whether this was a bubble popping, the US quietly announced a $12 billion strategic critical minerals stockpile and called an emergency level ministerial with more than 50 countries. That just happened. Both markets and policymakers are telling you the same thing at the same time. Stay with me because I'm going to show you why this move isn't random, how to recognize it next time, and what you should be watching starting tonight. Before I explain what caused this, let me teach you something most people never learn about commodity crashes. When you see violent selling that ignores fundamentals, you're usually not watching investors change their minds. You're watching forced behavior. Think of it like a crowded theater where someone trips near the exit. It's not panic at first, it's physics. In leveraged markets, price doesn't move because opinions change. It moves because balance sheets break. When volatility spikes, margins go up. And when margins go up, weak hands don't get a choice. They sell. You've seen this before, even if you didn't realize it at the time. The key is learning to separate emotional selling from mechanical selling. If you can do that, you're already ahead of most of the crowd. Now, what's mechanical selling? It's when traders have to sell, not because they want to, but because the math forces them to. Let me explain how this works in markets where people are trading on borrowed money. You put up $10,000 as collateral. The exchange lets you control maybe $50,000 worth of silver. That's leverage. You're playing with 5 times your actual cash. As long as the market stays calm, you're fine. But the second volatility kicks in, the exchange says, hold on, we need more collateral from you. They raise the margin requirement. Maybe now you need $15,000 to hold that same position, but you only have 10. What do? You sell, you have to. It's not emotional, it's mechanical. The computer doesn't care about your thesis, it cares about your account balance. And here's what makes this pattern so predictable once you know what to look for. The selling creates more volatility. More volatility triggers more margin hikes. More margin hikes force more selling. It feeds on itself. You get this cascade effect where price just falls through levels that should have held because nobody's making a decision based on value anymore. They're making decisions based on survival. Their broker is liquidating their positions whether they like it or not. So when you see price action that looks insane, that looks disconnected from any rational analysis of supply and demand, ask yourself this: is this opinion driven or is this balance sheet driven? Because if it's balance sheet driven, you're watching something that burns itself out. It's violent, it's scary, it's fast, but it's temporary. If this is making sense so far, drop a comment below and let me know where you're watching from. I want to know who's paying attention to this stuff in real time. Now, here's what's actually happening in silver. Let me break down the sequence step by step. Silver had gone parabolic, pushing toward $120 as speculative positioning and momentum fed on itself. Traders were piling in. Retail was buying. Momentum funds were chasing. You had this reflexive loop where rising prices attracted more buyers, which pushed prices higher, which attracted even more buyers. Classic late-stage price action. Then volatility surged. And I mean really surged. The VIX for silver, the volatility index, spiked to levels we haven't seen in years. Exchanges responded immediately with margin hikes. The CME raised margin requirements on silver futures. Other exchanges followed. Funds that were long silver on leverage suddenly had to post more cash. Some couldn't, so they sold. That selling pushed prices lower, which triggered more margin calls, which forced more selling. That's the cascade I just described. But here's what's wild about this particular move. The selling coincided with reported short covering by major banks near the lows and temporary outages in key trading systems. Now, I'm not saying that's proof of anything sinister. I am saying it's a textbook sign of stress in the paper market. When you see trading halts, when you see system outages, when you see banks reportedly covering shorts right at the moment of maximum panic, you're watching infrastructure strain under pressure. That's not normal market behavior. That's a market that's breaking in real time. And here's the part that should make you nervous if you're not paying attention. While paper silver was imploding, Governments were signaling that physical metals are now strategic assets. The US announced a $12 billion critical minerals stockpile. They're calling emergency meetings with 50 plus countries to discuss supply chain security. They're explicitly naming silver, along with other metals, as essential to national security. That's not noise. That's policy. That's convergence. You've got mechanical liquidation on one side, massive forced selling in the paper market, and on the other side, you've got policy driven demand. Governments saying we need to secure physical supply of these metals. When those two collide, you don't get tidy price action. You get air pockets and snapbacks exactly like the one you're watching right now. Now, let me show you what very few people are talking about. There's a disconnect happening between paper prices and physical prices. When silver was crashing in the futures market, dealers were reporting that physical premiums stayed elevated. Coin dealers weren't dropping their prices in lockstep with the paper market. Refineries weren't seeing canceled orders. In fact, some were reporting increased demand. What does that tell you? It tells you that the selling pressure was concentrated in the leveraged paper market, not in the physical market. The people who wanted to own actual silver, the people who were buying coins and bars, they didn't panic. They kept buying, some of them probably bought more. It was the leveraged speculators, the traders playing with borrowed money who had to sell. And they were selling contracts, not metal. This is critical to understand because it shows you where the weakness actually was. The weakness wasn't in underlying demand. The weakness was in over-leveraged positions that couldn't sustain themselves when volatility spiked. If the fundamental thesis for silver had broken, if industrial demand had collapsed, if the policy backdrop had reversed, you'd see that show up in physical markets. You'd see premiums collapse. You'd see coin dealers slashing prices. You'd see refineries going quiet. That's not what happened. What happened was a mechanical unwind in the paper market while the physical market stayed relatively firm. That's actually bullish in the medium term because it means the liquidation cleared out weak hands without damaging the fundamental structure underneath. Zoom out for a second because this isn't new. This is the same playbook we've seen before in other commodities that crossed over from being just cyclical inputs to being strategic resources. In the 1970s, oil didn't just rally because demand rose, it repriced because governments decided energy security was national security. OPEC used oil as a geopolitical weapon. Countries realized they couldn't just rely on markets to deliver energy. They needed strategic reserves. They needed domestic production. They needed alliances with producer nations. And once that shift happened, oil stopped trading like just another commodity. It started trading with a national security premium baked in. The floor moved up permanently. Even when there was plenty of supply, even when demand was soft, prices stayed elevated because the strategic value had been repriced. After 2008, gold didn't just drift higher because of monetary policy. Central banks turned it into a balance sheet anchor. They started accumulating gold at a pace we hadn't seen in decades. They weren't buying it to speculate. They were buying it to diversify away from dollar reserves. They were buying it because they'd learned that in a crisis, gold is the only asset that's nobody else's liability. And once central banks started treating gold as a strategic asset, the market changed its rules. Gold stopped trading like jewelry demand was the main driver. It started trading like a monetary asset with a sovereign bid underneath it. The floor rose. Volatility increased first because markets had to reprice what gold actually meant, but then the floor rose and stayed elevated. Every time a commodity crosses the line from cyclical input to strategic resource, the market changes its rules. You see it in uranium right now. You saw it in rare earths over the past decade. You saw it in lithium when batteries became critical infrastructure. The pattern is always the same. First, there's a price spike driven by tight supply or rising demand. Then there's volatility as markets try to figure out how to value this thing. Then governments step in and say, this isn't just a commodity anymore. This is national security. We can't let markets alone decide this. And that's when the floor moves. That's when the rules change. When you look at silver through that lens, today's chaos starts to look less like a top and more like a transition. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be a speculative blow-off that ends badly? Absolutely. Could the talk about manipulation be overblown? Yes. Markets don't need villains to break. Leverage alone is enough. I've seen enough market cycles to know that you don't need conspiracy theories to explain violent price action. You just need too many people on the same side of the trade with too much borrowed money. When that unwinds, it's brutal, and it doesn't require anyone pulling strings behind the scenes. It just requires math. Could silver go back down and retest the lows? Sure. Could this rally fail and turn into another leg lower? Of course. Could the policy announcements be more talk than action? Maybe. Governments announce strategic initiatives all the time that don't actually materialize into sustained programs. So, yes, I'm aware of the risks. I'm aware that this could be a dead cat bounce in a larger bear market. I'm not sitting here telling you that silver only goes up from here. That would be irresponsible, and honestly, it would be stupid. But here's the thing, it doesn't actually matter whether there was manipulation or not. It doesn't matter whether some bank was scheming or whether this was just pure market mechanics. The mechanics are what matter. The fact that leveraged positions got liquidated, that's observable. The fact that physical premiums stayed firm, that's observable. The fact that governments announced strategic stockpiling programs, that's observable. Those are signals you can verify. Those are data points you can track. The mistake people make is focusing on stories they can't verify instead of signals they can. You don't need to prove who did what. You need to watch how price behaves around key levels, how volatility compresses or expands, and how policy headlines line up with physical demand. That's actionable. Everything else is just noise that burns your energy. So here's what I want you to answer in the comments. Are you watching silver right now? Are you holding physical? Are you trading futures? Are you just observing? Because there are probably three types of people watching this video right now, and I want to speak to each of you directly. The first is the trader who feels like they missed the move and wants to chase. If that's you, slow down. Seriously. Your edge isn't speed. Your edge is patience. I get it. You see silver rip 12% in a day, and you feel like you need to get in before it runs away from you. But that's exactly when you make mistakes. That's when you buy at resistance. That's when you ignore risk management. That's when you size positions based on FOMO instead of based on your actual plan. Let the market prove it can hold above $85 to $90 before you assume anything. If this is real, if this is the start of a new leg higher, you'll have plenty of time to participate. It's not going to run away from you overnight. And if it does, then it wasn't meant for you anyway. The moves that work are the ones where you have a clear plan, a defined risk, and you're entering with conviction, not desperation. The second is the long-term holder who just lived through a gut punch drawdown. If that's you, I get it. You watched your position go from up huge to down significant in a matter of days. That's painful. It messes with your head. It makes you question everything. But this is where you zoom out and ask whether the thesis actually broke or whether you just experienced leverage unwinding around you. Did industrial demand for silver collapse? No. Did the green energy transition reverse? No. Did governments suddenly decide they don't need critical minerals anymore? No. What happened was a mechanical liquidation in the paper market. If you own physical silver, if you're holding coins or bars with no leverage, you didn't get margin called. You just had to watch the price move. And yeah, that's uncomfortable, but it's not the same as being wrong. The question you need to ask yourself is whether the reasons you bought silver in the first place are still intact. If they are, then this is noise. If they're not, then reassess. But don't let short-term price action override your long-term thesis unless the fundamentals actually changed. The third is the skeptic who thinks this whole thing is a circus. That's healthy. Your job isn't to believe the hype. Your job is to watch whether silver can reclaim $95 to $100 and hold parity with Shanghai pricing. If it can't, if it rolls over here and makes new lows, then yeah, this was probably just a short covering bounce in a larger correction. But if it can reclaim those levels, if it can hold them, if physical demand stays firm and policy support continues, then you need to update your view. Being skeptical doesn't mean being stubborn. It means being willing to change your mind when the data changes. So watch the data, watch the price action, watch the policy signals, and be ready to admit when the market is telling you something different than what you expected. Different mindsets, same principle. Don't react, observe. Let price confirm the story, not the other way around. So here's where I stand. I'm not euphoric, and I'm not bearish. I'm focused. Let me tell you what I'm personally watching. First, I'm watching whether $85 to $90 holds as near-term support. If silver can base here, if it can consolidate in this range without breaking lower, that tells me today's bounce has real sponsorship. That tells me there are buyers willing to step in at these levels, not just short covering. If we break below 85 with conviction, then okay, we're probably going lower. But if we hold, that's constructive. Second, I'm watching $95 to $100 as a confirmation zone. That's where global pricing starts to agree again. If silver can reclaim that range and hold above it, that's when I start thinking, okay, the liquidation is over. We're transitioning back to an uptrend. That's where futures prices and Shanghai prices converge. That's where the paper market and the physical market start trading in harmony again. Until we get there, we're in no man's land. We're in this messy zone where anything can happen. Third, I'm keeping $70 to $75 in mind as a deep washout level. I'm not predicting we go there. I'm not saying that's likely, but I'm aware of it as a risk scenario. If this rally fails, if we get another wave of liquidation, that's the zone where I'd expect to see real capitulation. That's where long-term holders start throwing in the towel. That's where the final flush happens. Again, not a prediction, just risk awareness. I want to know where the pain threshold is, so I'm not surprised if we get there. Based on my analysis, this move was mechanical, not emotional. The selling was forced liquidation, not a fundamental reassessment. The policy backdrop is validating, not fading. Governments are moving forward with strategic stockpiling. Industrial demand for silver is still growing because of solar, because of electronics, because of electric vehicles. The green energy transition isn't reversing. If anything, it's accelerating. So the fundamental picture hasn't changed. What changed was the technical picture. We had too much leverage in the system, volatility spiked, and that leverage got flushed out. That's healthy in the medium term. It clears the deck, it resets positioning, it creates a cleaner foundation for the next move. And if history rhymes, if silver follows the same pattern that oil followed in the 70s, that gold followed after 2008, the move that follows could be substantial. I'm not making a price prediction. I'm not telling you silver's going to $500 or $1,000 or whatever number people want to throw around. What I'm saying is that when commodities transition from cyclical inputs to strategic resources, the repricing is usually larger and longer than most people expect. It's not a straight line. It's not smooth. But the trend is persistent because the underlying driver is persistent. Governments don't wake up one day and decide critical minerals aren't critical anymore. Once they make that call, they follow through. They build stockpiles, they secure supply chains, they create sustained demand that didn't exist before. I'm not a financial advisor. This is not financial advice. I'm sharing my analysis, my framework, the way I'm thinking about this market, but you need to do your own research. You need to make your own decisions. You need to understand your own risk tolerance and your own time horizon. What works for me might not work for you. What makes sense in my portfolio might be completely wrong for yours. So take this as education, not instruction. If you made it this far, you're thinking critically. You're not just looking for someone to tell you what to do. You're looking to understand the mechanics, the patterns, the framework for making your own decisions. That mentality will serve you well. That's how you survive markets long term. Not by following someone else's calls, but by building your own understanding of how markets actually work. If you found this valuable, share it with someone who's trying to make sense of what's happening in silver right now. Subscribe if you want more analysis like this, and stay sharp out there. Think critically, verify your data, and make your own decisions. I'll see you in the next one.